All right. Matt, the mortgage guy here. Have you thought about buying a fancy house and you don't know whether it's a better idea to do a first and a second mortgage or it's a better idea to do a jumbo loan? In today's video, I'm going to talk about the pros and the cons, what you need to know about a first-second combo, and about a jumbo loan, what might be best for you, my personal opinions, and all that stuff. Before I jump into it, if you like straightforward mortgage content, real estate content, what I see as a mortgage broker day in and day out, talking to hundreds of consumers, hundreds of real estate agents, please consider subscribing to the channel, like, comment, do all that stuff. Special shout out to SASHA. This is how most of my videos get started. Somebody asks a question. Hey, this is something I want to hear about. So SASHA, thank you for answering the question. Hopefully you find value in today's video and I answer what you were looking for. That's where a lot of these videos come from. You as a viewer, as a subscriber, ask me questions, I answer them to the best of my ability. All right, let's jump into it. So it's very common, especially in California where I'm at, people are buying houses above the conforming limits. Not everybody has 20% down to put down on a house. So they're looking for ways to structure their loan where they're going to put a 10% down payment. And in some circumstances, like I'll show here behind me, that might be in the jumbo realm, above those conforming limits. And so you've got a couple different options. You can use a jumbo loan where you put down 10% and then you just have a first for 90% of what you purchased the property for. Pretty straightforward and simple. There's other cases where for a number of different reasons, you might want to take a first loan that goes up to that conforming limit or close to it, and then take a second loan for the difference between this loan amount and 90% of the purchase price. That also allows you to put 10% down. So I'll go into it, some pros, some cons, some stuff that's equal between the two, and then I'll let you decide what might be best for you. So first and foremost, I wrote down jumbo, 10% down. These loans that I'm writing are at a fixed rate. That is definitely a pro for a lot of people. Adjustable rate mortgage scares the heck out of a lot of people, which it probably should. You want some certainty. You want to know that next year, the year after, 5 years, 7 years, 11 years from now, if you stay in this mortgage, it's not going to change, right? The principal and interest payment is going to stay the same because it's a fixed rate. On the first, second combo, I wrote fixed/adjustable combo because more often than not, this isn't the case in all of them, right? But more often than not, that first is fixed. The second is an adjustable rate. Now, sure, I put the asterisk here because some of those seconds you can find a fixed rate term, but more often than not, that's adjustable, right? Okay, so on to the next thing, no PMI with these jumbo 10% down loans. Makes it very attractive, right? If you bought a house where you were nearing the top of the conforming limits, and let's say you were in a high balance county in California where you could have a loan all the way up to $822,375, if you put 10% down on something in that range, your mortgage insurance would be a lot. Even with great credit, you might have $400 or $500 a month in mortgage insurance. With this fixed rate, 10% down jumbo, no mortgage insurance. Huge, huge benefit, huge pro, right? No PMI in this case as well, because what you're doing is you're taking a first and a second and, putting 10% down. Your first might be 80%. It might be 75, it might be 70, right? But you're not going to pay mortgage insurance on this first loan because it's below 80% loan to value. So that's one of the pros of this first, second combo is you're not paying mortgage insurance. I put this down because I thought it was important to take into consideration debt to income. And when you compare both of these to a conforming loan, both of these are going to be more restrictive, as you would imagine. It's higher risk to the lenders. So it's going to be, in most cases, capped at about a 43% debt to income ratio on both, right? And as you can imagine, a lot of companies who write these second loans behind these firsts are in a pretty, I don't even know what the right word for it is. They're taking on a lot of risk. They're putting their second behind a first. Somebody's buying a $1 million house, $1.5 million house. They got their little second hanging out behind this first mortgage. This is risky, and because it's risky, it's going to be more restrictive. They might even have DTI requirements that are even less than this, or a bunch of reserve requirements, or something else, right? But I don't want to say restrictive because up to 43% DTI when you're buying a home that big is a great looking loan, but more restrictive than your standard conventional loans, right? And so with all this being said, one last thing I want to cover is that both of these are going to be options to get in with 10% down. I haven't compared these to like, what if you were buying up near the limit and you wanted to put 10% down? That's a whole different animal. This is what I was asked to compare, and I think this is really the choice that most people have when they're like, I'm going to buy $1 million property, I'm going to put 10% down. What can I do? Jumbo 10% down or some sort of combo loan. A lot of people call these an 80-10-10. I didn't put that here because it's not always 80-10-10. As you'll see in my example, let's say you're buying something for 1.2 million, you're putting 10% down, and then to get your loan, your first, whoops, I put those backwards. To get your first down to the county limit, which LA County, San Diego County, San Francisco County, these high balance counties in California, that 822,375 is the limit. This is the first, I wrote it down backwards, and this is the second. In order to get the first loan down to that, your second is 257,625. So this is more like, instead of an 80-10-10, this is more like a 70-20-10, meaning 70% first, 20% second, 10% down. I know those aren't exact, right? It might be 68-22-10, but you get the picture, right? It's not always an 80-10-10 because you need to get the first to conforming limits, right? In some counties, this might be 598. In other counties, it might be 6.25. In the high balance counties in California, it's 822,375. I put this down so people could see you've got this structure, or you've got that same $1.2 million purchase. You've got 10% down, 120,000 down, that's 10%. And then you've just got $1,080,000 first loan. This is 90% of your purchase price. One loan. Now, excluding taxes and insurance, $4,850 is the monthly payment at 3.5% down. I'm sorry, at 3.5% interest rate. That might be a rate with no points being paid, right? Now, if you do it this way, I wanted to show this because this is the stuff that you should take into consideration. You've got pros and cons. You're like, well, I like the fact that this is fixed, but if this is a lot cheaper, maybe I risk having an adjustable second that can change if I can get it cheaper. Well, if this first, which you gotta realize, the fact that you have a second, the lender's taking that combined loan to value into consideration when they're pricing your first. Your first isn't going to be the same pricing that you would get if you put 30% down and finance 70%. Some people don't realize that. Since your combined loan to value is 90%, the lender goes, well, we're going to factor in that risk. Your rate's 3% instead of 2.75. So your 3% first is $34.95 a month. If you've got a 3.99 adjustable, it starts at $3.99. First and second are $47.20. You compare that to the jumbo loan, sure, you save $130, but for how long? Does this adjust after year one? Does it adjust after year two? It's stuff to consider, right? And a lot of times I'm not selling anybody on anything. I'm literally presenting options and saying, you decide. Do you want to go through getting a first and second? This is a little bit murkier of a loan process. This is a little bit more in detail. Some stuff that I was reading about talked about how you might have to pay closing costs on the first and the second. I don't know if that's necessarily true. I think cost-wise, they're relatively similar. The big difference in my mind is, do you want the absolute certainty that you got a fixed rate and that's staying put? Or do you want the slightly lower payment, but your second can adjust? Another thing to consider is, how long are you in these loans? Maybe you refinance out of this in 12 months or 18 months, 24 months, who knows? But jumbo loan versus combo loan, I'll let you decide. One thing to take into account, I've got a lot of jumbo loans, and I know a lot of jumbo lenders across the nation are marketing this product, selling this product, making it easy and streamlined to where I truly believe this one is probably getting, why am I putting a check mark there? Less people are probably doing first and second combos nowadays than they were in the past. That's my guess. These jumbo 10% down products are getting better. They're getting streamlined and they're getting competitive enough to where there's not enough advantages on the combo loan side. Just my 2 cents. If you have any questions at all, please feel free to reach out, matt@mattthemortgageguy.com. If you're outside of California, I'd love to help you. Unfortunately, I'm not licensed there. I'll connect you with a great broker who is. greatmortgagebroker.com. Fill it out. It'll take you 24 seconds. You'll be connected to a great mortgage broker who I promise will take good care of you. Again, matt@mattthemortgageguy.com. If you're in California, reach out to me. Me and my team will be happy to help. I appreciate you watching. I appreciate the support. Until next time, let me know what questions you have. Happy to answer them. Talk to you soon. Bye-bye.